Good morning, good afternoon, good evening, wherever you are. Thank you for joining today's webinar and your time. My name is Ankit and I'm the co-founder of BIGGR Financial. BIGGR is a platform of SEBI-registered investment advisors and leading financial advisors who can assist you with your investment portfolio creation, review of your current investments, retirement planning in a conflict-free and an unbiased way. Coming to our exciting webinar topic today, we have Mr. Sagar Lele with us, who is a CFA charter holder, which is a very revered degree in finance and investment space. He's a founder of Rupeeting, a SEBI-registered investment advisory firm. With 11 plus years of stock portfolio building experience, a master's in finance from University of Reading, Sagar is a leading expert in the investment industry. Sagar, in his previous role, has worked on money management side with Daiwa Asset Management, which is Japan's second biggest asset management company with $200 billion AMC. He was part of their core investment team and his portfolios were featured in the top quartile. So, before I hand over to Sagar, let me quickly float a poll here. So this poll will actually gauge our audience insight. So it is appearing on your screen. Please vote. I will float this poll for around 15 seconds. Okay, so I'll publish the results and okay, so over to you, Sagar. Okay. Just give me 1 minute. Okay. Yes, welcome, Sagar. Okay, the webinar is yours. Okay. Your voice is not audible, Sagar.
Is it okay now?
Yeah, it's okay. Yeah.
Awesome. Hi everyone. Thanks Ankit for the introduction. Very elaborate. Thank you.
Yeah.
Yeah, it's quite ironic that after working in a mutual fund, I'm kind of doubting whether mutual funds are right.
Okay.
So, but having worked in the inner field, I think there are some nuances that people need to know about. It's not really about the working of mutual funds. Don't get me wrong, mutual funds are right. They are the perfect investment. However, if done right, and that doing right of mutual funds or investing correctly is in the hands of investors, and that's what I'm here to talk about. I'm just going to quickly share my screen so I
Yeah,
share a deck with you.
yeah.
You guys can see the deck, right?
Yes. Okay.
Awesome. So yeah, as established, I think mutual funds are right. If you don't have the time to manage your own money, build your own portfolio, this is a great instrument to be invested in. Professionally managed team of experts, great processes and systems in place, very articulately done a process, and everybody is always on top of their field and in terms of knowledge. So great way to invest in for sure. And given the fact that there are 15, 20 different categories of mutual funds to invest in, there's enough flexibility for one to maneuver around in terms of strategy, in terms of their own investment goals, in terms of whatever the investment needs are. So to construct a portfolio using mutual funds which is suited to your goals and needs, and which is suited to even your strategy if you have one, is fairly simple to do. But it requires some amount of monitoring of what you have in hand, what the composition of those mutual funds are. Because each mutual fund, if you've invested in a large cap mutual fund, you fairly know what the strategy is. You're going to be invested in probably the top 100 companies in the country. But the problem comes when you add another mutual fund. Say you add a mid cap fund, then you've got a composition, right? Then you add a fixed income fund, you've got a further composition in terms of composition change in terms of your portfolio. So the tricky part, or where most people go wrong, is not being able to manage or get a view of what their total mutual fund holdings are and how that stands in relation to whatever the strategy in terms of investments or their goals are. So there are two things that can go wrong. One is over diversification. I'll touch that first. And the second is lack of direction, which we'll come to later. That's all I'm going to discuss in terms of nuances or things that can go wrong in terms of building investment portfolios through mutual funds. The first is over diversification. Now, mathematically, we've all heard of not putting your all your eggs in one basket and all that. The simple logic is that if you have one mutual fund or even one stock, let's talk about stocks here, one stock, uh, you've got too much risk on yourself, right? So if you add another stock, what you do is you essentially cut the risk significantly because no two stocks could move in the same direction. That's the prime assumption here. Um, and at the same time, what you do is you also dilute on the returns because say one stock is 10% up, but the other stock is 5% down. You're going to dilute your returns. You're reducing your risk as well, but you're also diluting your returns. But the tricky part is that typically when you add more and more stocks, the amount of risk you reduce is not really proportional to the amount of return you're reducing. I'll make that simple for you. The way risk is calculated for a portfolio is that you take the variance, you calculate risk using variance. So the variance of the portfolio is going to be equal to variance of all the stocks that are in the portfolio plus the covariance of stocks with each other, right? And the covariance of, just a sec, excuse me, yeah, sorry. The covariance of all the stocks put together, that's something which can be termed as market risk, right? So the more stocks you add, you cancel the risk out of each other in terms of stocks, but you can't really get rid of market risk. Market risk is the risk that Nifty goes down, right? That the benchmark goes down, that the equity markets themselves go down. And that risk is something you can't really get rid of, how much ever you diversify. So essentially, what happens is when you come down from one to two stocks, you've reduced the risk significantly. When you come down from two to four stocks, you've reduced the risk, but not as much as you reduce the risk from one to two stocks. Right? And that's what the graph here signifies. So the risk is going to keep reducing, but as a lower function. Now, effectively, what happens is beyond 15 to 20 stocks, we've said 17 here, but beyond 15 to 20 stocks, um, you're going to reduce the risk much lesser compared to the returns, and that's what's going to cause inefficiency in your portfolios. I'm going to make this simple by quoting a research by a few people from the CFA Institute. What they did was they created a portfolio of 10 large cap stocks, right? And the volatility of those 10 large cap stocks was about 20%. However, if you increase that 10 stock portfolio to 40 stocks portfolio, the volatility only went down from 20% to 17%, right? So adding 30 more stocks to your portfolio reduced the volatility only by 3 percentage points. So essentially, you've not done a great job at reducing the risk. You've not done a significant risk reduction. You can't mathematically. And at the same time, what you've done is you've diluted returns much more. Because if you had a concentrated 10 stock portfolio and you were more or less right in terms of selection of those stocks, you would have done much better compared to having a portfolio of 40 stocks because the returns are going to cancel each other out and you're not going to end up with significant returns. Uh, the problem is that every single mutual funds, while the ideal number is 17, every single mutual fund has at least 30 stocks in the portfolio. Now, 30 is itself a number which is larger than our ideal number of 17. Uh, and the larger problem comes in when you've got many more mutual funds, right? So your number of stocks in the portfolio is going to shoot up to 100, 200, we don't know, right? And returns are going to cancel each other out. The risk reduction is not going to be significant, and you're going to end up with a portfolio which is over diversified and not really optimum for your money. There are a couple of ways of checking this in terms of uh, what your current portfolio is. I'm going to give you one tool, and that is Morningstar. Everybody can access this. It's free of cost. You can just go to morningstar.in, go to tools, and here you'll see something called as the um, sorry, yeah, instant X-ray. This is a very useful tool in terms of just determining what your overall holdings are. Now, I'm going to put up a random portfolio. Say you have a ELSS mutual fund, say HSBC LSS. You've got 25% allocation here. You've got one large cap fund. Um, let's say it's Baroda Pioneer. Okay, we'll select this one. You've got 25% here. You've got a mid cap fund. Say this one. And you've got, I think it's selected. Yeah, and you've got a focused fund. Access Focus 25, and you've got an equal weighted portfolio of 25% in each. Right now, you click on Show X-ray, and this is what you get. Now, I'm just gonna add a comparison with Nifty here. Let's just select a Nifty ETF for ease. Yeah, and here you see that over the last year, Nifty 50 ETF has outperformed this portfolio. Over 10 years, over 5 years, over 3 years, over 1 year. Randomly selected 4 mutual funds, diverse strategies, because you've got large cap, mid cap, and typically that's what would happen in your portfolio. I'm guessing you'll have multiple mutual funds across different categories. What this will result in is essentially a very diversified portfolio, 100, 200 stocks, and the returns are going to be lesser compared to Nifty 50. Where I'm going to come to is the standard deviation as well. Okay, I'm not getting the Nifty numbers here, but anyway, sorry. So point being, if you were to not beat Nifty 50 using your mutual fund portfolio, your mutual fund portfolio is no good. And you're paying 1.5 to 2.5% as mutual fund fees, plus your distributor fees if you've got any, to not beat the Nifty. The simpler thing to do in this case is either build your own portfolio. If you've got a strategy, if you've got the time, if you've got enough knowledge, build a portfolio of probably 20 stocks and stick with that over the long term. The other option is to just invest in index fund or ETF, right? Because if you're not going to beat the index or the ETF, you might as well just invest in it for 0.5% of fees, and you'll be better off in the long term than creating a jumbled mesh of portfolios. And the third option is obviously get an expert who would help you consolidate your mutual fund holdings and give it some sense or strategy or direction, and avoid over diversification through multiple funds.
Sagar, we would like to float a poll here.
Sure. Yeah.
So dear attendees, I am floating another poll. So please vote, and I'll again run this poll for 15 seconds. It should be on your screen. Okay, I see some people are still voting, so we'll give 5 more seconds. Okay, so here are the results of the poll, Sagar. So over to you. Yeah.
Clearly, everybody has invested in a lot of funds, and I think there is a dire need for everyone to check on their portfolio and see if they're one beating the index, right? I think at the end of it, that should be the objective out of your portfolio, at least the equity portfolio. We'll come to asset allocation and stuff like that elsewhere, but yeah. And yeah, so with that, I'll come to the second point, which is lack of direction. Now, one of the things I want to do this using an example, and I'll use the very recent scenario of interest rate hikes that everybody has been aware of over the last year. Typically, what happens is in a bond portfolio or with any bond, whenever interest rates rise, there is a decline in the price of bond. Right? There's an inverse relationship, pretty simple. Interest rate rise, bond price down. However, for a one, let's say for the decline in the price of the bond is higher for longer tenure bonds whereas it is lower for lower tenure bonds. Right? So a 1-day bond will see a lower price decline when interest rates rise, but a 10-year bond will see higher price declines when the interest rate rises. So in a typical interest rate rising scenario, you would want to place your bond portfolio in such a way that you have shorter term instruments and not longer term instruments. Right? That's how you'll make more money. I've just taken the returns in 2022 from bonds of different maturities. 1-day bonds give an annual return of 4.8%. 10-year bonds gave only 0.4%. Right? This was 2022, very relevant scenario. Um, However, now coming to a mutual fund portfolio, you'll obviously have multiple bond portfolios as well, debt portfolios. You'll have some which are purely fixed income mutual funds. You'll have balanced mutual funds. Balanced mutual funds may you'll have aggressive, balanced, conservative by different fund houses. And everybody will have a varying exposure of debt in their portfolios. More importantly, they'll also have a different strategy when it comes to dealing with their debt portfolios. So some funds will have a lower duration, some funds will have a higher duration, some funds by design, because that's the mandate of the portfolio, will have short-term bonds. Right. So just because the interest rates are rising, a long-term bond portfolio can't really change strategy to short-term because the mandate itself is long-term. Now you might be stuck with a long-term bond portfolio, but you'll have no idea. Right. So again, I'll go back to the screener, the useful tool that I showed you on Morningstar. And what you can again do here is just get a sense of um, what your bond portfolio could look like. Right. And I'm going to shoot out again some um, random bond funds here or balance funds in order to get a portfolio. Let's choose this one and the credit risk fund. Sorry. Yeah. And okay, so TSP, let's take this one. Oh, this is an index fund. Sorry, can't take this one. Yeah. So let's take 3 portfolios, do an equal allocation, show X-ray. And here's what we need to see here, right? Go to fixed income style. Okay, sorry. Yeah, so the effective maturity for this fund is 2.83, right? Wow, what an unlucky example. We got 2.16, 2.97, and 2.83. Typically, I was expecting something else here. But you could have two here. You could have some bond with a 10K maturity. You would have some with 5, effectively landing up somewhere in the middle. While ideally lower the better would have been preferred in this scenario. The important part is to check out the effective maturity, see if they are aligned and they're not canceling each other out. So if you've got one which is 7, one which is 2, and your portfolio lands at 5, you're more or less at average and without a direction or without a strategy, right? So you're not going to really make the most out of what is happening in the market at this point in time. So on an overall perspective, your portfolio may look right in terms of saying 70% needs to be in debt and 30% needs to be equity, and 70% must be in debt, which is a great sign. But are your debt holdings really making use of market movements? Is your strategy really aligned with where the market is? Probably not. And that's where a lack of strategy can really hamper your portfolio returns and subdue them. The other thing that can also happen is not just in a bond portfolio, but also in an equity portfolio, right? You may be exposed higher to mid caps. For example, you may have 50% exposure to mid caps, and only 50 to large caps. And for your asset allocation, which is ideal, say at 80% debt and 20% equity, your equity portfolio in itself may inherently turn out to be much more risky than you want it to be because of a large mid cap exposure. So these are things that you need to check on, because just overall constructing the portfolio basis percentages is not going to help. The solution is to get into details, see what the portfolio is about, and simplify things for yourself. So the solution is, one, if you've got debt holdings, check the duration of your funds, see what the market view is, and if you don't have a market view, that's all right. You just need to make sure that it's not all over the place. That's the important bit. The second is, a lot of people we've seen have multiple funds in the same category. So you would hold, say, Aditya Birla's large cap fund, DSP's large cap fund, and Kotak's large cap fund. Everyone's got the same strategy. Everyone's got an overlap in terms of holdings. Everyone's going to have about 100 stocks. You're going to end up with three different mutual funds with overlaps, over diversification, and again, just pointless addition to what you've got in terms of your mutual fund holdings. So with this, primary two issues, as I elaborated: one, over diversification; second being lack of strategy. To help you ease through the process, you want to float a question?
Yes, Sagar.
Sure.
Okay.
Yeah.
So, yeah. So we have one more poll, the attendees coming on your screen. So please vote for that as well. So this also is like just to provide you insights. Okay. Gauge our audience insights. Okay. So I'll run it again for 15 seconds. Okay. Okay. So I'll publish the result, and over to you, Sagar. Okay.
So yeah, I think the last part of my presentation, when it comes to, I've highlighted what the problems are, but there is a solution for it, right? It's to get primarily a hold of what's happening with your portfolio. So one is to consolidate all your holdings. First, understand what you have. And you can do this by either downloading your consolidated account statement, which is available on CAMS Online, or an easier way these days also is to go to mfcentral.com. This is a collaboration by the depositories itself. So you've got, sorry, the RTAs. So you've got a one-stop view for all your mutual fund holdings in terms of just understanding how many folios you have, what mutual funds you have currently invested in, etc. If you don't already have a distributor advisor or a single portal that you're investing through. Because if you're investing through a Grow, for example, plus you do something through a DSP site, it's not going to get consolidated. You're going to have to get a place where all your holdings, at least you are aware of first. So step one, either MF Central or download your consolidated account statement, get a view of what you have first. Step two, go to the free tool of Morningstar, check for overlaps, check for repetitions. There are some really cool features on the X-ray tool that I just highlighted. Apart from just seeing, I'll just probably show you some, apart from just seeing a total of your funds, you can also go into holding overlap. Right? This is more useful for equity, not the right example in terms of debt, but you can see how many overlaps there are. You can see the total amount of fees you're paying. At the end of it, if you're generating, say, 10% return, but you're paying 1.67% fees every year, but the market or the Nifty or the benchmark is generating 12% return, you're not doing a great job, right? Or even if you're generating 13.5% return, the management fees is cutting out into your portfolio. You're better off investing in just a market portfolio through a Nifty ETF or something. So useful tool. You can also go into individual mutual funds here and check out stuff. This may appear daunting and complicated, but just spend a few minutes on it, you'll be sorted. Even if you go into portfolio, ideally for a equity fund, you get to know how many stocks you have in the mutual fund as well. So that will help you with the diversification aspect as well, giving you some view of how under or over diversified you are, mostly over in this case. But yeah, step two would be to just recognize repetitions in terms of what funds are overlapping, what categories have multiple funds, what holdings are overlapping, whether you have a strategy in place or not. whether the risk is too high, whether the risk is too low, stuff like that. Step three, get an opinion. And that may be either, that can be two ways, right? One is either you have a goal in terms of asset allocation that's dependent on your age, on your number of dependents, on your life cycle, on your goals, for example, and you come to a asset allocation of say 40-60 or 70-30 or whatever that is. Or you have a strategy, you're more hands-on, you're more aware of what's happening in the markets, and you have a defined strategy in terms of saying, hey, I think for the next 2 years mid caps are going to do better, or I think interest rate cycles are going to reverse and interest rates are going to fall, and hence I need to be placed in longer term bonds. If you have such an opinion, you need to go back to your mutual funds and see whether your opinion and the mutual funds are matching in style or not. If they're not, there is corrective action required. And corrective action is just to cut out the flab, keep it simple, keep the funds as minimal as possible. Even if you have multiple in the same strategy, cut the flab out and consolidate the portfolio into something better. Yep. So you can do this yourself. You can get an advisor. Um, Mutual funds at the end of it are right, provided you do them right. Most people don't know whether they're doing them right or wrong, and that's what this webinar was about, to give you a little bit of glimpse on what can go wrong and how you can recognize what's going wrong and take some corrective action towards it. Questions, if any, we'll open it up, Ankit.
Thanks a lot, Sagar. Thanks for the wonderful insights about everything that you shared. I think our audience and attendees, it was very beneficial for them. So, the attendees, I would float a last poll here. So please vote. Okay. And after that, we will go to the question and answer. So I'll again run this poll for 15 seconds. So please vote. It should be on your screen. Okay, so I'm publishing the results. Okay. So yeah, with this, we open the session for question and answer. So dear attendees, if you have any questions, please put in the chat and we'll pick one by one. Just picking some questions here. So we have one question, Saga, here. So in a longer run, will it be safe and profitable to choose index funds? If you don't have too much insights on mutual funds, what is your opinion? This is asked by Mr. Sumit Kalyan.
See, index funds are, uh, like there's a different take on it. In India, it is possible to, and mutual funds have exhibited active returns or have beaten the market consistently historically. Um, in more developed economies, you see that not happening very often. So there is a whole loss of faith in the active management of mutual fund space internationally, and passive funds have taken over hence, right? So they are cheaper, and they're and active management is not able to beat index funds, and hence that pickup has happened. In India, active management works. Um, it has worked so far consistently as well in a lot of cases. Uh, so again, going back to, if you have a mix of mutual funds, uh, chances are that you may not be able to beat the index if you've not got your strategy right. If you're not aware of what your strategy is, if your advisor is not aware of what the strategy is, and if you've not placed yourself according to what that strategy is. And that strategy can be across market cap. You can be heavy on mid caps at a point. You can be heavy on large caps at a point. You may choose value at a point. You may choose growth. For example, the last 3 years before the last year, growth worked phenomenally. Value didn't work. In 2022, value worked phenomenally. Growth didn't work at all. So having a strategy that is also dynamic is important. So if you've had that strategy, and if you're playing the market well, if you're choosing the mutual funds correctly, if you're aligned, you can beat the index. If you're not, and if your advisor or distributor is not equipped to do that, or has historically not done that, then you're better off just investing in an index fund. It's way simpler. It's let's let's just say there is a possibility or probability that you'll beat the index or not, which you're playing on. With an index fund, you are just betting on the index. So you're getting satisfied with saying, forget beating the index. I'm just going to play the index and pay 1.5% lower fees. And that works. And over the long run, over 10 years, over 15 years, anyway, indices have exhibited 12%, 14% CAGR. I think that's a happy return to be on. So if you want simplicity, if you do not have a strategy to beat the market, if you don't have the willpower or willingness, let's not call it willpower, if you don't have the willingness to beat the market, if you're not too bothered, it's just like, hey, I just want to stay invested and make money, index funds work.
Okay, thank you, Sagar, for answering that. Another question that we have from Venkatesh Mathad is that I would like to go for an advisor to manage my funds. How can I get assistance?
Uh, that's something you can answer better than I can answer.
So yeah, I think we have a lot of financial advisors on our platform.
I
So
can promote
Venkatesh,
myself, but I'll leave that
yeah,
to you.
yeah. Yeah, yeah. So we have Sagar is there and Rupeeting is there, and we have some more financial advisors on our platform. So Venkatesh, you can submit your query, and we will be able to assist you. Okay. So I hope that answers your question. Next question we have is from Mr. Puneet. So this question is that if there are some standard strategies on ETF or mutual funds or mix for managing investments. This question was a bit incomplete, but I completed that. So are there some standard strategies for investments in ETF or mutual funds or mix of all?
Not really. Unfortunately, uh, standard doesn't work in investing.
Mhm.
And if you
Okay.
stick to a standard strategy, that strategy is going to fall apart because the market is dynamic. So
Okay.
the only standardized strategy is to keep it dynamic. Uh, that would be the only strategy. If you don't have that dynamic strategy, it's better to invest in index funds because
Okay.
then you're not trying to beat the market, you're just being the market.
Okay.
So no, I wouldn't recommend a standard strategy. Also, it depends on investment goals, right? I'm focusing a lot on strategies here, but it also invest on it depends on goals. Um, if, for example, you've got a 50-50 allocation across equity and debt, but you've got a large purchase coming up in the next 2 years, um, you might want to move more of your money to debt just to safeguard the expenditure and ensure that it doesn't go down in value because of the volatility faced in equities. So I think it depends a lot on strategy plus personal factors that come into play when it comes to building a portfolio. Um,
Okay. Yeah, thank you, Sagar, for answering that. So I think I have just one last question, and that is my own question, Sagar. So it's like, okay, how can repeating assist all the retail investors to like invest their money and like remain invested or get good returns? So how can repeating come into picture?
I think we've realized that over diversification fact long ago, and being in the market and being or managing a fund, I've kind of come to a point where I don't see a point of holding 100 funds, 100 stocks, or 100 funds, or whatever. Right. So the primary proposition at Repeating is to create concentrated portfolios of 10 to 15 stocks
Mhm.
and constantly build and manage those. And we've got a team of experts who do that. We've got a research team of 9 people, research and investments, who constantly are on the lookout for stocks, changing strategies, keeping an eye on the market. Everyone's got like a decade of experience in the markets. So our goal is to very clearly beat the market and keep changing the strategy ourselves so investors don't have to do the hard work by themselves. So that's one proposition in which we do help retail investors build better strategies with their money. The second thing we do is also provide a lot of research. That product
Mhm.
has not picked up, or we've not finished building the product entirely yet. But the objective is to, if you don't want an advisor, if you want to do your own research, we want to be able to help you make some meaningful get some meaningful insights out of whatever you're researching. So if it's any stock that you want insights about, we are there to simplify that research process and not make it as intimidating as it can be by doing it yourself or by reading complicated broker reports. And the third thing, of course, is we offer personalized advice through platforms like BIGGR, where we're available to hear out what people's investing problems are and devise strategies for them, not just basis our view on the markets, but also combining their own personal standing at this point in time. And a combination of the two is what works the best for everybody, right? There's no one size fits all approach, and it has to be personalized. So we're available for that as well.
Okay, thank you, Sagar. So there's one more question that has come up. So
Yeah.
that is our last question, and that question is PMS versus mutual funds. So which one is better?
You got 50 lakh rupees to invest in a PMS, great. Good for you. You made it. No, but no, if you've got that kind of money to be invested in one particular PMS, I think that works better from a return standpoint. Because again, it doesn't over diversify. It simplifies things. It keeps the portfolio intact, and PMS has demonstrated beating mutual funds because of the whole concentration factor. Right, mutual funds have constraints because of regulation, because of how they operate, because of size, because of stuff like that. They have constraints in terms of how many holdings. What if you have a large cap scheme, it has to be 65% large cap. If it is a mid cap scheme, if it has to, so those compulsions don't exist in PMSs. So PMSs have the ability to switch from strategy to strategy depending on markets rather than sticking to a mandate because they started a fund with a certain objective. So PMS, if you can afford one, definitely works better. However, I think you've got to be very, very careful about reading the fine print and getting to know and understanding clearly what the fees associated with the PMS are. So there is not only the management fee, but there can be a profit share, there can be a distribution fee, and there can be a profit share which can be 10%, 20% beyond a hurdle rate. There is a watermarking that happens. So there are multiple terms and conditions which can get into PMS, and the cost or the profit share, you need to make sure that it's not so high that you're better off investing in a mutual fund. So while PMS can work better, I think cognizance of costs is very important when it comes to analyzing which one to go for.
Okay. So I think PMS is, so we had a query on this. PMS is portfolio management schemes. Okay. So
Yeah.
there was a query from one of the users that what is PMS here. So with this, we come to the end of our webinar, and thank you, Sagar, for wonderful insights in this webinar. I hope those were helpful for our audience. And to all the attendees, thank you very much for your time on Saturday morning and taking out time out of your busy schedule. And if you have any query, please don't forget to visit our website and submit your query, and we would be happy to assist you. Okay, so our website is biggerfin.com. Okay, yeah, thank you very much. Thank you, Sagar.
Thank you. Thanks, Anju.